We've all asked this question, who's right here, the bond investors or the equity investors, as we were watching, this divergence, right? So it turns out it might be the bond investors who are correct. I mean, do you believe that we're going to see further declines here because of that?
Well, I do think that bonds ultimately lead stocks, but they can lead by very, very long margin, right? In the last two cycles, what we saw is the mid-90s bond spreads started widening for 3 years before the stock market ultimately peaked. The same thing happened 2005. Bond spreads reached their tights. They widened all the way till late 2007 before the equity market finally reached its all-time top. So you can have these periods of divergence that last long periods of time. I think we're actually in one of those right now. We've had a pretty significant correction. It's unlikely we see too much more of that correction unless it leads to economic deterioration.
Because the past has said that when credit spreads widen this much, that we usually see a correction of about 18 to 20%.
Right.
We're down about now 12% from the peak.
Well, and you've also got to consider the fact that in the past, the earnings yield on stocks has been at a different level, right? The PE on stocks today relative to the yield on bonds still suggests that equities are actually fairly attractively valued relative to bonds. So I think you have to look at these things in historical perspective. You also have to consider where we are today. And we did have a pretty significant correction. If we do see economic deterioration around the horizon, I'll have to change my mind, right? Usually equity market tops occur when credit spreads are widening and the likely outcome of the economic outcome over the next 12 months is a worsening of conditions. That's not the experience that we're in today. Instead, we see a lot of financial market turmoil, certainly a lot of currency and commodity price-led turmoil with respect to risk tolerance, but not necessarily a broader, longer-term breakdown in the economic situation.
So that was going to be my question, what would make you change your mind? But when you wind up looking at stocks, yes, okay, they're cheaper after the last correction, right? S&P is around 16.5 times PE, right? But cheap isn't always good enough. You still need the earnings growth. How do you grow when you wind up seeing financial conditions deteriorating?
Right. Well, we are growing. We still have earnings growth of somewhere between 0 and 2%, like it or not, despite the fact that energy sector earnings are plummeting at a 50% rate. And I think that that's what's being completely and totally overlooked right now. The center of weakness, the center of pain is very clearly the energy sector. And you see that extend a little bit to industrials, materials, but sectors like healthcare, for instance, are still producing 12% earnings growth year over year. You've still got somewhere between 8 and 10% earnings growth in the tech sector. So there is a divergence of experiences within the S&P 500 that is notable right now. What we'll see going 12 months forward is if oil prices don't fall anymore, the worst of the pain is done for earnings. Well, unless you start to see the housing market turnover, the consumer stocks turnover, the healthcare stocks turnover. And then we have a much broader and much deeper correction, probably in stow. But for now, it's really a tale of two worlds. And the energy sector is at the greatest pain.
Well, and speaking of, if you take a look inside my terminal, I bring this chart up all the time because it's so telling. You see oil prices and oil stocks moving in tandem, but then around 2013, you saw oil prices continue to slide, whereas energy stocks held up.
Right.
Gina, do you think that they recorrelate and then therefore energy stocks need to fall further, or is this a story of oil prices catching up?
Yeah, it's probably a story of oil prices catching up. I mean, a lot of it depends on the dynamics of change over the next 3 to 6 months. I mean, a lot of it is dependent upon how rapidly energy sector estimates fall relative to analyst expectations, right? So right now, analyst expectations are extremely low. I mean, right now, the embedded price at an analyst expectation for earnings on the energy sector is somewhere around $50 a barrel.
Yeah.
We don't have to go too much higher on oil to get to $50 within the next 12 months. If oil prices fall further, though, let's say we're pressing $30, energy stocks will have to correct because analyst estimates for energy sector earnings will have to fall. So stocks, I think, react to earnings estimates even more so than they do the absolute price of oil because analysts can precede that oil price.
Isn't it, though, a sign of an unhealthy market, though, if we are so clearly dominated by what happens in one or two sectors? I mean, isn't that in and of itself a sign of an unhealthy market, in which case maybe it is time to bail?
It certainly is a symptom of, a market that is running on very few legs.
Yeah.
And that's been the case all year. It's not just now. It's not even just starting in June or July. Through the entire year, tech, healthcare, and consumer names have really led the market higher. Defensive stocks and commodity-sensitive stocks have lagged the market so far this year. What I would worry about is if we do start to see a much bigger defensive leadership start to take hold, if you see the cyclical stocks turn over with energy, materials, industrials, if healthcare loses its leadership, if technology loses its leadership, much worse if the consumer names levered to U.S. growth start to lose leadership, then we have a much bigger problem. In the way it stands now, you can lose some breadth in the commodity-sensitive sectors and still see the market sort of hang in there. We've seen that. We've seen a lot of it. My sense is a lot of that is actually past. But will we get, do I think that this is the absolute bottom? Was last week the absolute bottom? I don't know, quite frankly.
Right.
And it,
it feels like there's more of a shakeout. But
we will see some volatility, in my opinion, until we see oil prices stabilize, until we see China stabilize.
I got to say, so, I hate to be, so I feel like, half the time, I spend most of my life here, because we're working all the time. But so last week I was off, and I was able to finally, get out and walk around and
Any sad vacation.
I was
See the world.
It was a sad vacation, but I was at the mall. I was with my kids, went back to school shopping, and I couldn't help but notice that there were several stores in the mall. It's a high-end mall, and also on the streets, in the town that I'm in, were closed. Like small shops, and we were counting them. I mean, I counted 6 or 7 were closed, and it was enough for me to say, are we in some sort of retail recession, and is that a signal that the consumer is turning over right now?
I don't think so. If you look at the retail sales aggregates, they certainly wouldn't tell you that. The rate of retail sales has been slowing along with gas prices. But if you exclude gas prices and you exclude vehicle sales, you get a pretty stable pace of core sales. I think what you're witnessing is a broader transition in shopping behaviors and spending patterns to online retail and away from brick and mortar. And the retailers themselves are migrating their business models toward the online model, trying to appeal to the way that the consumer shops today. You're not the only one that's stuck in your office all day long and too busy to get out into the world.
There you go.
Right, and most of us are, fairly productive, but working long hours in today's economy. Part of the result has been a lack of time to actually move ourselves to the location to do the shopping that needs to be done.